And yeah, so a little bit about us, about me in this case. Originally from Italy, started Equidam in the Netherlands about 10 years ago now. And well, 8 years actually, after Master in Finance and Investment, and been doing really startup valuation for 8 years now. Worked on everything from 20K family and friends rounds to our largest one was a 2 billion fundraise on the Nasdaq, and everything in between, really, in every type of industry. But yeah, what are we going to cover today? We're going to talk about why valuation a little bit. What are the trade-offs in doing it versus not doing it? A quick outlook on valuation methods. We already covered them last time. And then how to make and how to use financial projections in a useful way, not like in a time-wasting way. How to calculate then the valuation on Equidam, again, in an efficient way. And then the last two things, what can we learn from conducting valuation about a startup that we cannot know without conducting a valuation? And the last thing, how do we think about portfolio valuation as well? Obviously, this being geared towards investors, right? Why do you have us today? You have us because we are at the moment, I would say, the small niche leader of startup valuation around the world. We valued more than 130,000 startups. We have more than 1,400 investors using us across the world. And we've been doing this for a while. But, today is not really about us. We're really trying to give a lot of notions. And obviously, we probably have all kinds of knowledge around valuation and startup investing in the audience today. So some things are going to be maybe easy to digest for some of you. I think we always try to cover the principles, and so to stimulate reasoning around valuation, not really to go into the super small details that more often than not in startup valuation are not the main point of contention, right? Generally, we're discussing whether it's 1 million or 10 million, not the €2 or something, or $2 differences. But so first of all, right, we don't have, do we have the results of the poll? Would be very interesting, but I can't see them.
Yes, the results say that about half participated last time, and the remaining not.
Okay, so then split in the middle doesn't really help us. Okay, no problem. We're just gonna do it at a normal pace. So first of all, right, why do you consider valuation as an investor? Well, obviously not to overpay, right? Not to at least consistently overpay on every deal, right? Ideally, and also not to be outbid on a deal that will still be at a good price, right? So the thing is that, as we said last time, you're doing valuation anyways, right? You are still either confronting or taking the market price, right? And if you're not doing valuation, you are just reflecting a little bit less on whether that price is correct or not, right? So the funny thing for me is that I believe it was not correct for a long time. Like in the last, 15 to 20 years, startups were undervalued and investors made very nice returns, right? Valuations in the last maybe 2 years or 3 have been way up compared to before. But are they overvalued? In my opinion, not really. But we have reached a market equilibrium, I think, where the returns are related to the risks that the startups have. Before, the risks, especially of SaaS startups, were not, in my opinion, understood. And now they are. So things have kind of normalized, I think, in terms of returns and prices on that side. But, this is something that I think we saw very early on with the difficulty of lowering valuations and the feedback that we were getting on the calculations that we were doing. It's always difficult to judge the absolute price of things, right? Why should you do valuation? Is valuation worth it? Has another point of obviously how mature is the startup, right? So the more it is mature, the more it's worth it to investigate, simply because at the beginning there is a lot more uncertainty, to the point that accelerators and incubators just like don't even consider the question and offer a standard deal, right? So the only question that they consider is this startup deal appealing to enough companies that are going to become unicorns, right? Or are they going to be left out and they're not going to accept the standard deal? But they don't feel like they should worry about valuation at that stage, right? As soon as the accelerator finishes, like people are already worrying about valuation a little bit, right? A lot of saves, a lot of convertible notes are used, which a little bit bypass that question, but they create other questions, right? And then like stages that are following that definitely involve more valuation work, right? So it's a little bit of a question of like how developed the startup is. And the last thing is obviously like, is it worth it to do valuation? Well, it depends on the cost, right? And the cost of it, decreases substantially by using tools. And we'll see Equidam today. We're pretty unique as a tool, but I think like probably there are other valuation platforms. So, you know, in general, if there are tools that make the process faster by still having those learnings, we have you know, good things that can happen. So how do we do practically? How do we do valuation, right? How do we do valuation for startups? So the first thing to consider is the valuation methods, right? And we covered this last time, you know, maybe a little bit more in depth that we're going to do today. All the methods, they kind of stem out of risk and return, right? When we look at startups, at least in the lens of financial investments, we are trying to compare the risk return of this type of investment, of this specific startup, let's say, versus other startups, versus other instruments, financial instruments, other ways to have a return on that money, right? But in terms of guessing and judging the risk return aspect of this specific startup, we have, in my opinion, two categories of methods, right? We have comparisons, which can be very crude or a bit more refined, and we have intrinsic value. So in terms of crude, we have multiple scorecard checklist types of methods, and we'll talk a second about those. Refined DCF, venture capital, real options, and intrinsic value, book value, or cost to duplicate. So yeah, in terms of multiples, right? So just like a little bit about each of these methods for who wasn't there last time. Multiples, very simple method of like multiplying an underlying metric of the company for an average or median of other companies, right? You can pick number of users, revenue, EBITDA, anything, number of square meters of fields that the company is growing crops in, you know, everything can be used as a multiple. The pro is that it's quick and easy. The con is that it's difficult to find reliable multiple data, and it's very simplistic for early stage companies because like they're all very different, and just applying one multiple to one number is very reductive as an approach. A little bit more refined, we have a scorecard and checklist, which are basically methods that compare the company with, in the case of the scorecard, average valuation of similar companies. We try to judge this company on whether it's better or worse in our case, 6 criteria. And then if we believe it's better, it's going to get a value that is higher than the average valuation. If it's worse, it's going to get lower value. And worse doesn't mean worse. It means just that they might be a little bit behind compared to other companies that we have an opportunity to invest in, right? Pros is very detailed in terms of a qualitative analysis, and it really allows investors to specify their preferences and their learnings in the weights that they use for each criteria and in the criteria that they specify. The cons is that it has little financial element and difficult to find comparable data on this one as well. That's kind of going to be a common theme, right? Checklist, similar idea. We compare in this case to the best startups, like what we think a startup in this stage could be worth if it was like perfect, let's say. And then we say, okay, this actual startup is not perfect, and we discount that value by a certain percentage. Again, good qualitative analysis, difficult to find data, similar to the previous one. We have discounted cash flows, right? Everybody, I think, is familiar with discounted cash flows. They're used to value everything, right? From oil rigs to options to everything. We do them as well on Equidam. We give them more weight when the projections are more reliable, which generally happens when the startups are a little bit more mature, not really at super early stage. The pros is obviously it has a very detailed financial analysis, and it also puts returns in a broader context. It compares the returns with like stock market returns, industry returns, if you investigate the discount rate. And it's very sensitive to discount assumptions. So if you've used DCFs, you know that they are a bit sensitive to those assumptions. VC method, I think also everybody familiar. This is a very simple method and very interesting, to be honest. It basically just like you need to figure out what's your multiplier that you need to every startup to have in order for your portfolio to return what you want it to return, right? And then if you find out that every startup like needs to be worth like 10x, let's say, you can calculate basically backwards the valuation, right? You calculate the potential of the startup, and then backwards you calculate how much it should be worth now in order to give you that 10x return, right? So it's very quick and very easy, and it also has the benefit, I think, of keeping perspective on the end goal, which is not, you know, to calculate to the second decimal point the discount rate of something, but it's to understand whether this startup has a big potential or not, and what's our confidence in that outcome, right? It has little qualitative analysis. It is very sensitive to discount assumptions because we're looking at longer periods of time. We're looking at 10 years maybe return. And it is a bit simplistic, like we saw that, with a few changes in assumptions, it can change the value quite a lot. Real options, this is like the advanced sort of methods for that you probably have heard about valuation of startups. So I put them here just for context, right? This basically assumes that a startup is a bundle of options that can happen in the future, and all of them have some value, and then this method uses stock option pricing models to calculate the value of the startup. Like, to be honest, for us, this gets so complicated that it loses any meaning. It doesn't add any value to the analysis of the startup, in our opinion. But it has a pro that it focuses on possibilities. What I always think, though, is that financial projections from founders generally include all the possible possibilities sometimes, but it's good to keep an eye out for possibilities. Book value and cost to duplicate. These are kind of the methods that look at the past. So the book value, obviously, how much is the company worth on its books? So the assets, the previous costs accumulated, and minus the amortizations and depreciations. And the cost to duplicate, how expensive would it be to replicate this company? They're not really used for startups, just because the book value has a lot of difficulties in accounting for intangibles that are super important for startups, and the cost to duplicate kind of assumes that, that we're not investing in the future of that company, but we're just interested in duplicating what they made. So also not very useful as a model for investing in startups. Interesting pros, because they have a completely different view. We just don't think they are worth the effort, specifically when talking about startups. So as you can see, we're left with 5 methods. Those are the ones that Equidam uses, but of course, this is more of an overview about all the methods that are available for startups. And the important thing to take away, though, is that ideally you would always use more than one method, because each of them has a different point of view, has different biases, and has a different take on comparing risk and return, as we just saw. So this is kind of like, everybody's advice. Obviously, the costs of doing a valuation analysis increase with the number of methods that you use, right? And what we saw for us is that the qualitative methods are always like a baseline of our analysis. They kind of include all different futures, because they're kind of the assets of the company, let's say. The VC method generally sits stably in the middle, and the DCFs account for specific futures that the company is aiming at the moment, and they could change. So when the companies are super early stage, DCFs are only reflecting the value of the current plan, but the current plan is going to change almost for sure. And then we revert back to the qualitative methods that are more, let's say, general. They apply to a more general startup that doesn't have a very super specific plan yet. And then as the company matures, it does get entrenched, let's say, in that plan. And we put more weight on the DCFs, and the valuation reflects more the financial future of the company. So I think it's a very interesting combination and point of view on this. But unfortunately, some of these methods depend on financial projections, right? Which is kind of the thing that nobody wants to talk about at early stage. But in my opinion, they are super important. So they're important for different purposes, though. So I want to cover a little bit how we think about financial projections and how they can be useful for you as an investor, and also what we tell founders as well. This is exactly the same thing, almost the same slide that we use for founders. We just removed the instead of show. Your level of ambition is like show level of ambition, right? So projections have different purposes, at different stages of the company, right? So at super early stage, projections are an indication on the level of ambition of the company. They show the budgeting, knowledge, and ideas of the team. They show an understanding or lack of understanding of the market, an understanding of unit economics, and an understanding more or less of whether there could be a potential positive cash flow at scale, at least, right? And if the founders are even thinking about that, and how are they thinking about things, right? At later stage, so on the complete opposite of the spectrum, they need to show how predictable the growth and the company are. They need to show the growth engine of the company. How does the company continue to grow in the future, at least in the foreseeable future, right? Then growth engines kind of run out of steam, and then it's about the team and how much they can find the next one. And then they allow people to calculate precise valuation. So at early stage, we're not looking at those projections to get a precise valuation out of them necessarily, right? But then as the company matures, and obviously this is a continuum, they become more and more important, to the extreme of stock market valuation, where the qualitative things are not even taken into account, right? So I think the first insight into properly done financial projections is that they give us an insight into this feedback loop that the founder goes through when creating them, which is the feedback loop of their ambition that funnels into their strategy, that funnels into the financial projections, that then are used to adjust that ambition, right? Until this is a solid and cohesive plan that is that matches their ambition. So I think this is quite interesting and something that a lot of people don't think about often. And the other thing of useful financial projections is, when they are made properly, is to show the growth engine of the company, right? Even at super early stage, like it could show at least what the team thinks distribution channels can be and what they can return, and especially at early stage, this is gonna show what are the critical assumptions, right? And that's why I really think at early stage projections are very useful, is because they show the critical assumptions, and they're useful obviously for the founders and for them to understand what the critical assumptions are, but also for you, if you want to invest in the company, you should probably double check those as well. So if the growth engine is set up properly, this is just an example of one growth engine, but this can be modeled very relatively easily on Excel, right? And what we always see missing is a linkage between revenue and costs, right? And here there are some examples, right? We could have 3 salespeople per marketeer, 1 support person per 1,000 subscribers, 1 manager per 6 employees, 1 marketeer per 1 million of marketing budget. These type of things are good. Are the linkages that you want to see, that allow you to tweak one number and understand how sensitive things are to that assumption, right? So how does this look in practice? Because obviously I think it's quite difficult if people are not used to Excel to understand that. Maybe something like this, right? So we have here a sample Excel, paid advertising, growing at a certain, on this we have control, right? So this we can actually forecast a growth of paid advertising that converts into a number of clicks. We have, in this case, we have organic growth that grows at a certain percentage. Obviously, these are assumptions. This brings a number of total visits that converts into new subscribers, and then basically the Excel goes on. But if we look at the cost side, here we have an example of marketing staff, 1 marketing person per 150,000 visits, I guess. And we also have supplemental staff to account for idiosyncrasies in that specific strategy of the company. Not going to go into too much detail on this, but if you want to find our sample on what we consider the state of the art of financial projections, you can find it on just Google Equidam projections template, and it's there available. A tip that we have, if you're going to use Equidam, is to make a tab for projections in the format that we have on Equidam. That just makes life a lot easier. And as we saw, making life easier makes this analysis more useful to perform. So as you know, right, these type of models have a tendency to blow up. And so what we always advise people, and I just wanted to mention it here as well, is to double check a little bit top down. So double check, we have an article, if you Google Equidam average growth rate, about the average forecasted growth of our startups in different industries, in different countries, in different stages of development. And so to know more or less what is normal. And we always advise to try to find some general benchmarks of the most critical variables, right? So what we always say is that you want the company to stand out, right? But you want the company, because of course you don't just want to invest in the average company, right? So you want the startup to stand out, but they need to stand out on the right things, right? Not just because they don't know about, benchmarks, or they don't know about something. So this double checking is always useful to do, in my opinion. So now we have, in theory, right, we have a good understanding of financial projections and a good understanding of the methods, right? How do we do how can we conduct the valuation analysis in a, in an efficient manner? And well, for that, right, I mean, you can definitely build your own tools or find something, but we just wanted to show you quickly how you can do it on Equidam. And for that, there's my colleague Giulio is going to walk you through a brief demo of the platform, and then we're going to be back for portfolio valuation and a bit what we can learn from the valuation of startup companies. Giulio, the floor is yours.
Thanks for the great introduction, Daniel. I think you've covered most of the important bits. So this is going to make my life a lot easier, taking everybody through the platform. Cool. So this is, as Daniel mentioned, the Equidam platform, the portal where the valuations are being done. We've designed it in a way that it really takes you through the whole process, kind of in the most hassle-free and quick possible manner. You see here in the dashboard we have a breakdown. So this is where the 5-point methodology that Daniel was talking about earlier comes into play, with the weighting of the 5 methods depending on the stage of development. Of course, we average those 5 numbers and we get to your pre-money valuation. The process of gathering that qualitative and quantitative data that kind of populates those 5 methods is very straightforward. So we have a questionnaire that's designed to gather all of that important qualitative data surrounding the team, the business model, the product and market, the IP and legal. It's a very straightforward little questionnaire, mainly multiple choice questions. It doesn't take very much time. And then the financial projection section, as Daniel was mentioning, very important to also have the financial projections in order, are just keyed in through a little financial projections table here. The rest of the platform looks at gathering more data, right? So I think for the purpose of these reports, really highlighting transparency about the funding round. We have things like company profiles, where you're able to really build a report around the company's data. One of the important bits, which I think are very useful for kind of the professional side of things, so maybe not so much for the startups, but we also give you a lot more control over the model and how to actually do the valuation. So you have the ability of kind of picking and choosing which valuation models you want to take into account. You can kind of fluctuate the weighting manually as well. I'll highlight that here. Activating custom values, you're able to really kind of fluctuate those weightings, and maybe if there's only DCF applicable in the situation, you're able to as well only use DCFs if you need. As well, on top of that, we have a methods criteria, so you can see all of the base parameters of all of the different methodologies. So the DCFs, you can see what the discount rates are comprised of, the EBITDA multiples. You're able to really adjust those as well to match whatever situation you're facing. I think, Daniel, as well, you were talking earlier about the weighting of the criteria. You can choose which sections of the qualitative methods might be more applicable for that company. So we really give you a bit more kind of hands-on ability with how to value those companies. On top of that, we believe that valuation is an iterative process, so you have the ability to as well generate as many reports as you need on Equidam. You can highlight as many different versions of the same valuation reports. You can go back, you can change data, so you can adjust financials, maybe make them less or more optimistic than what they need to be. And generating reports directly on the platform is as easy as clicking Generate Report. The platform puts it together. It comes in a PDF deliverable, about 25 pages if everything is inputted onto the platform, and the platform is sensitive to what you're not inputting. So if you don't highlight certain elements, it won't appear in the report as well. So then let's have a quick look at the reports, and then I think I can hand it back over to Daniel. So as you've seen kind of through the flow of inputting that data, whether it's the questionnaire that takes very little time, or the financials as well, if you have those made beforehand to just key them in, the flow of actually getting that report can be done. I mean, I've seen clients do it within an hour. I've seen clients do it within less. So yeah, the flow's really been designed to be able to take you through the process. So the reports are, we start with the front page, a company logo. We build a little bit of a company profile, so you can get a bit kind of breaking the ice between the two sides of the table. Your forecast summary looks a bit at the future profitability, cash forecast. We start analyzing a bit those financial projections that you inputted before, coupled with additional aesthetic information, and then we get to your valuation pages. So we highlight, of course, the pre-money valuation, the methodology, the weighting of those 5 methods to really highlight how the valuation is being put together, not just what the final pre-money valuation is. We highlight the current funding round as well, highlighting what the fair deal is, also low bound and high bound to leave room for negotiation. At the end of the day, it is still a negotiation between 2 parties. And then we dive a bit deeper into the methodology. So I won't bore you with this. I think, Daniel, you've already gone through the different methods, but it's important to highlight kind of why the valuation has come to what it is rather than just what the valuation is, right? So transparency is key, providing all of the data that we can. We have a bit of a breakdown into the qualitative data, so really highlighting those important qualitative aspects of the company, especially for those earlier stage companies, and then of course your financial driving methodologies, your VC method, your DCFs. You can see the flow of calculation, as well as all of the parameters that we highlighted earlier. And then I don't think any report would be complete without a profit and loss and a cash flow at the end. And then I think just for the sake of transparency, we do have an appendix which dives deeper into our data sources, where our data comes from, kind of what the criteria are built off of as well, so that if there's any further doubts about the calculations or about the data, that's all I highlighted here at the end. Yeah, and that's pretty much Equidam in a very quick nutshell.
Awesome, thanks. Yeah, exactly. So like we're basically trying to facilitate the implementation of those methods, but there hasn't been any well, I mean, of course, we had to streamline the process and to streamline the questions, especially on the qualitative side. But otherwise, like all our methodology is open, like potentially very, you can do it yourself. Like we haven't reinvented the wheel, let's say. But, I think like still, however you do it, the valuation analysis itself teaches us something about the startup that we don't learn if we don't conduct it, right? So, and these are a few things. They're not in any particular order, but for me, like, yeah, better understanding the risk-return profile of the opportunity is something that we never stop considering. I think if there are 2 opportunities that one is very risky and has a very high return, and the other one is, let's say, less risky, a bit more quote unquote certain, with many quotes, and the return is lower, like which one is mathematically better? Assuming that they have the same, that you get the same offer, that you can do the same offer for both, but one has the higher valuation than the other. Another interesting thing is like try to estimate the hype coefficient of the deal, like try to bring some objectivity to the deal and see if there are, so later, like there are biases in the judgment that we're making, right? And be more objective, obviously, across different opportunities. I think that's what a rigorous valuation analysis can do, and also I think judge the depth of due diligence necessary. So if a valuation is like in the middle or it's a bargain, like obviously maybe less due diligence can be sustained. Like we need to go through a super amount of due diligence, while if it's an expensive opportunity, might still be worth it, but we might want to double check things a little bit more. And another super important thing is that it allows us to understand what's the sensitivity of this company to different things, right? So one is towards major assumptions, right? What are the things that need to be true for this company to be a good opportunity? And you can generally boil it down to like a couple, and see whether you believe it or not, or you believe in those assumptions as much as the founder, or at least in the same neighborhood, let's say. And the other thing that I think is interesting is that valuation is the only way to understand how future bound this opportunity is. So if you have a company that is returning 100K per year, and another one that is returning 500,000 in 3 years, but nothing in the middle, like, how do you judge which one is better? How do you judge which one is a better investment, right? And so yeah, this type of quantitative analysis, I think, is the only way to figure these things out, right? So obviously, again, right, the complexity needs to be feasible, right? So obviously, you cannot spend 6 months on each valuation, unless, of course, it's super huge. But you know, so there is to be a balance, and what we're trying to do at Equidam, but I think what the goal should be is to get as much of this with as little effort as possible, you know. Now, the last thing that I wanted to touch upon is portfolio valuation, obviously. So we get asked this a lot, right? And I feel like nobody ever reflects on what is a portfolio. So it sounds very simple, but how do you define it, right? So because like there are some interesting questions, like a group of companies is, you know, like, okay, it's a portfolio, right? But how about a game developer with multiple games? Can that be a portfolio? Is that a portfolio of companies? Is that a portfolio in general? How do we value that? What about, like, if there's a software company that is leasing an office from a real estate company, you know, how about that? And you know, what if we have like one company that its only customer is another company in the same group, let's say, no? So these type of questions, obviously, investing, like private equity in general, goes like from all the spectrum, right? It's like, it could be like Warren Buffett style, where it's very difficult to understand whether they are a company, an investment fund, a portfolio of opportunities, you know, very difficult to understand. To, you know, like somebody like, I don't know, Sequoia or something with, you know, very delineated funds, relatively standard types of investments, equity investments, simple, right? So there is the whole spectrum, right? So the important thing is that is important to understand. So if we look at the spectrum, right, I think it goes from like a fully disconnected portfolio where the companies don't even know that you are, you know, investing in several companies, let's say. On the complete opposite of the spectrum, there is the single business unit, right? The indivisible, which could be, sometimes there are single business units that are bigger than, you know, than the whole portfolio of an investment fund, right? So it's not a matter of size, it's a matter of how connected are the pieces, right? And it matters for valuation, because we get always asked, like, okay, how do I calculate the valuation of my portfolio, right? So depends on what your portfolio is. If it's a fully disconnected portfolio, it's relatively straightforward. Not going to spend much time on it. It's like the valuation of the portfolio is just the valuation of each participation, and, like, you know, you sum them up. And this assumes that there are no synergies, right? And again, this has like a bit of a little bit of quotes, because like it assumes no important synergies, right? So obviously, if you are the investor in two companies that can potentially have a synergy, you're going to introduce them, right? Does that make your portfolio worth more than the sum of its parts? Yes, in theory. In practice, again, it's so difficult to calculate that is not, it's almost not worth it, right? But then, you know, let's say that you start actually doing some business development for one of these companies, and, you know, you introduce them to other 5 companies of your portfolio, and then they decide to buy one of them, and then, you know, they decide to supply a new service for the other 3. What's happening there, right? And so it evolves into a spectrum. Well, generally not, but it can evolve into a spectrum. On the other side, we have the single business unit, which is basically only synergies, right? It's okay, it's inputs, right? Raw materials and synergies between those raw materials. So in this case, the valuation can only be conducted as a unity, right? So you need to sum up all the costs, you need to sum up all the revenue, and calculate financial projections and calculate the valuation of the whole thing. again, that's very easy as well. But like, what if, you know, there's a subsidiary that is only supplying its parent company, right? Well, that's also still pretty easy. We can value the group. So we get a lot of questions from entrepreneurs that have a company and they are starting a new project and they're wondering how to value. So whether they should value the group, whether they should get an investment in the company group, or whether they should spin out this new project and raise capital for the new project, right? And how do you do the valuation of that? And again, right, and that project is a lot of times is very much connected to what they do before. Maybe they share web development resources, maybe they share know-how, you know, or sometimes it's exactly the same thing, just in another location. So yeah, important considerations here. And the synergies is basically where it's at, right? And it's a spectrum of how much synergies there are in and how interconnected the portfolio is. So yeah, just wanted to touch on that. I think for the majority of people, you know, the value of their, if they call it a portfolio of investments, is generally disconnected and is generally no synergies. But just wanted to touch on this to expand, you know, hopefully the understanding around portfolio valuation. So yeah, with this we are done for today in terms of the material that we have prepared. And yeah, we hope we added value for everybody, and we'd be happy to open it up for questions. So I think at the moment we don't have any questions in the Q&A.
Eye on the chats and the Q&A, there hasn't been anything so far. Okay,
so anybody has any questions that wants to put them on the Q&A or on the chat? Oh yeah, Mukatsi, I think it's easier if you type it out on the chat or on the Q&A. Do you have any questions, Giulio?
I'm more than satisfied with the information. Yeah, if you guys need to get in touch as well with Equidam, if you have any further queries or if you want to get in touch with us, there's the email address here, info@Equidam. I do demo calls throughout most of the day. We can have an introduction as well if you want to get in touch if you have any further questions. We do remain available. We're friendly. We don't bite. And we generally get back to you quite quickly. So
that's true. That's true. And I think like on that, if so we have our like sample valuation report, valuation methodology, and financial projections. Everything is on equidam.com/support. So you know, feel free to head over there, and you're gonna find quite a bit of material. And our blog is on equidam.com/blog. Yeah, there it is. Awesome. So Pablo is asking, for the DCF methods, you make an assumption on the exit multiple that can have a big impact on the valuation. Yeah. How do you decide the exit multiple? Yeah, that's a good question. And that's for us, we use the industry multiple according to the industry the company has specified. In general, yeah, that is a sensitive assumption, and like the way to do that is to find, you know, ideally 5 or 6 companies that are, or like let's say between 5 and 10 companies. More than 10, it becomes very impractical. That resemble the risk-return profile of that company in that moment. So if you apply the multiple on, let's say, 3 years from now or so, like where is this company gonna be, more or less, and can we find, you know, a few similar companies to analyze and to understand what is their multiple and use it, right? So obviously, yeah, not an easy thing to do, and but yeah, that's the only way for us. That's why also, you know, for example, we use DCF with multiples and DCF with long-term growth, because at least, you know, that assumption, that point of view that the multiple has, which is, you know, the market is right. I am able to identify similar companies to this one. I am able to find the multiple, and the multiple is more or less correct. At least is a bit sidestepped in the other method. Yeah. Awesome. And Mokatsi asks, currently launching a microfund, 150 startups. Will be great to have a closed-in session. Yeah. Well, we're always happy to collaborate with the environment, with the startup environment, and, you know, accelerators. But also we work with crowdfunding platforms, with corporate venture capitals themselves, and advisors and consultants as well. So yeah, hit us up on info, and we'll find, you know, what's the best way. We do, you know, we do webinars. Obviously, we have our product. We have knowledge on our materials that we can share. So hopefully we can add value. Yeah. Awesome. Well, I think that's it for questions. Yeah. If anybody has any more questions, you know, feel free to reach out to us on LinkedIn, on info@equidam.com, anywhere. Always happy to help. But I think otherwise we can, for today, we can let everybody go. Okay, 2 more questions. What are the biggest shortcomings in our model? Yeah, that's a good question. So I think, so we're working towards improving our multiples, speaking of the question of Pablo before, and getting them more detailed. So obviously we always want to get more detailed, right? Especially if there isn't any additional cost of data gathering, right? So that's kind of the balance that we are playing with. And the other thing that is an important aspect for us is a lot of startups don't plan to be profitable in 3 to 5 years, right? And DCFs, in order to have a positive valuation, they need to have a positive cash flow. So there is kind of this almost unspoken agreement in the whole environment that we're going to show some profitable forecast, and if there is extra money, we're still going to reinvest when the time comes. And everybody knows that's kind of the agreement. But and there is no model to actually model a company like Amazon that has been losing money because they were pushing on growth for, you know, 20 years or whatever it is. And so, like, yeah, so that's something that we're also working on a little bit further in the works. But yeah, those things I think can add a lot of information to our output. Yeah. How do you take time frame into account when applying the VC method? Yeah. So what we do with the VC method is that we try to take as much time as we have in account. And that means that if the company forecasts 3 years, then we only use 3 years. We don't want to make assumptions on something that even the company cannot make assumptions on. So instead, if the company has a forecast for 5 or 10 years, then we use the 5 or 10 years. So, and we apply the multiple at the end of the horizon, and we calculate an exit value, and then we discount it to the present. So yeah, that's how we do it. And in terms of our own discounts, so basically what we did is that we reverse calculated the required return for investors at certain stages of companies, right? And then we annualize that. So we have a required return, a required yearly return that then is flexible to be applied to any time horizon. Yeah. What about a freemium model? Yeah, so we used to have a freemium model up until 2019. And yeah, like it was a bit of a choice for us to move to a paid upfront model, mostly because we saw that for our product, the added sort of distribution advantages of a freemium model didn't really compensate, it wasn't really working for us as a distribution model. And so we just moved to a pay upfront model. And it allows us to do proper customer support because we have less inflow of people using the software for free, and it allows us to follow our clients a little bit more closely. Yeah.
I think we have covered all the questions. Thank you very much, Daniel. Thank you very much, Julia. It's a pleasure again. The recording will be shared on our LinkedIn, as well as we will send emails to all the participants, so you will get access to could check again or refresh your memory, and we'll also post a summary later on the kind of overall approach and valuation topic to our blog. But this will all be shared around. So thank you very much once again. Thank you to all attendees, and looking forward to seeing you again elsewhere.
Yes. Thanks a lot, Seren. Thanks a lot, everybody.
Thanks so much, Seren. Thanks so much, Dylan, guys. Thank you.
Thank you. Cheers. All right. Bye-bye.
Bye.